Hi, welcome to the Christensen Wealth Management broadcast of the weekly market commentary from LPL Research, dated January 22nd, 2018. This report is titled Fourth Quarter Earnings Season, Off to a Good Start. It was written by John Lynch, Chief Investment Strategist of LPL Financial, and Jeffrey Buchbinder, CFA, Equity Strategist of LPL Financial. It's early in the season, but with about 50 companies having reported fourth quarter results, S&P 500 index earnings are tracking a 12% year-over-year increase. See Figure 1 in the PDF of the report. A solid 79% of the companies have bested earnings estimates, while 87% have topped revenue targets, both well above the recent and long-term averages. In this week's commentary, we preview fourth quarter earnings season and reiterate our optimism for corporate profits in 2018. 6 reasons for optimism. The S&P 500 has exceeded quarterly earnings expectations for 34 straight quarters, and we see no reason why the fourth quarter of 2017 won't make it 35. We believe an increase in the 14 to 16% range may be achievable, based on a 3 to 4% average upside to estimates historically. Though earnings growth may be driven mostly by technology and energy, growth is expected to be broad-based with a reasonable chance that all 11 sectors will report growth in earnings when all results are in. See Figure 2. Even excluding the sharp rebound in energy sector profits and despite tougher comparisons against improving late 2016 earnings, a double-digit gain in S&P 500 earnings appears likely. Here are 6 primary reasons why we expect another good earnings season this quarter relative to expectations. 1. Economic surprises. The U.S. City Economic Surprise Index, a measure of economic data relative to expectations, is near record highs. When economic activity surprises to the upside, as it has consistently done in recent months, companies tend to beat estimates. Global economic surprises are also strongly positive, supporting multinationals' earnings. This unexpected tailwind, combined with management teams' tendency to be conservative and the lack of negative macroeconomic surprises, points to good upcoming results. 2. Strong manufacturing activity. Manufacturing surveys, such as the Institute for Supply Management's Purchasing Managers Index, have historically been well correlated with earnings growth. That means the strong and generally rising global manufacturing indexes are a positive indicator for upcoming earnings reports. The U.S. ISM Manufacturing Index has been above 58 for 5 straight months, which is strongly expansionary. As with economic surprises, this is not just a U.S. story. Manufacturing activity has picked up steam recently in Europe, Japan, and China too. 3. Weak U.S. dollar. During the fourth quarter of 2017, the U.S. dollar index fell about 6% year over year based on average prices. See Figure 3. Dollar weakness props up overseas earnings for U.S.-based multinationals and could present a tailwind for fourth quarter earnings, given that roughly 1/3 of S&P 500 companies' revenue is earned outside of the United States. 4. Pre-announcements. The ratio of negative to positive pre-announcements for the fourth quarter at 1.6 is as favorable as it has been throughout the entire economic expansion. Though in line with last quarter, this ratio is better than the year-ago quarter of 1.9 and the long-term average of 2.8. Fewer negative profit warnings have historically led to better than expected earnings results. 5. Stable estimate revisions. Analysts typically reduce earnings estimates during the quarter being reported. However, throughout the fourth quarter of 2017, estimates remain largely unchanged, while 2018 estimates rose, in part due to the new tax law. Resilient estimates are a positive sign for fourth quarter results. 6. Higher energy prices. Average crude prices were 12% higher in the fourth quarter of 2017 than the prior year. See Figure 4. If consumers pay more at the pump, and consumer spending is 2/3 of the U.S. economy, then how can higher oil prices help earnings? The answer is that S&P 500 earnings are more manufacturing and capital spending oriented than the U.S. economy. Higher oil prices mean more profits for energy companies, 6% of the S&P 500 weighting, and also more investment in energy infrastructure via the industrial sector. We believe these 6 factors will be the biggest drivers of potential earnings upside this earnings season. However, there is also a potential lift from hurricane-related rebuilding efforts, a positive, following the weather-related earnings drag in the third quarter, mostly from insurance losses. And though not a clear negative, write-downs related to the new tax law, particularly in the financial sector, have been garnering a lot of attention. We expect the market to look past these tax hits and focus on the benefits of the lower corporate tax rate. But the headlines aren't helping investor sentiment. A lower tax rate leads to reductions in the value of future tax assets, and taxes paid up front for repatriating overseas cash are both in the pay now, benefit later category. Robust 2018 earnings outlook. With the passage of the new tax law in late December, we upgraded our forecast for earnings in 2018, as well as our economic growth and S&P 500 return forecasts. Specifically, the new tax law and the potential boost to corporate profitability led us to raise our 2018 S&P 500 earnings forecast from $142.50 to $147.50, representing annual growth in the 12 to 13% range, which may prove conservative. As noted in our Outlook 2018 Return of the Business Cycle Research Report, we believe 2018 earnings will be supported by stronger global economic growth, a pickup in business spending, and strong manufacturing activity in the United States. We also think operating margins will remain strong and stable, thanks to our expectation for only modest upward pressure on wages and other input costs. The increase in 2018 estimates, even if largely due to analysts factoring in the new tax law, is encouraging as 2018 begins. Conclusion. We expect a strong fourth quarter earnings season and a mid-teens increase in S&P 500 earnings. Looking ahead, we believe our forecast for low teens earnings growth in 2018 is well supported by our forecast for accelerating global economic growth and the new tax law. Although we may see a pickup in volatility in the near term, we believe our earnings expectations for 2018 support further gains for stocks over the balance of this year. Thank you for listening to this podcast of the Weekly Market Commentary from LPL Financial. You can find a PDF copy of this research report in the summary section of the YouTube link, and you can also find it at christensenwealth.com under the Research tab. Have a great day, and I look forward to talking to you soon.